Thanks. First of all, thanks for having me. I'm very glad to be here and sharing my thoughts with you. We've long argued actually since the beginning of the year that the inflation pressures, as a main scenario, yes, maybe it is going to be temporary. But given what's interesting is not what's going to happen to inflation per se, but where the risks still lie, and more importantly, where valuations with respect to, let's say, to yields and to equities are. So we still believe that the risks to that are on the upside, meaning that even with the Fed's pivot, it's more likely that still markets are underpricing some extra tightness in U.S. monetary conditions. Now, right now, I think that the market and Fed are kind of equally priced with respect. When I say markets, I mean the short end of the U.S. curve. Right now, the short end of the U.S. curve is kind of pricing one hike in 2022 and two more hikes by end of 2023, and the Fed says only two hikes by the end of 2023, and the consensus lies with tapering starting from the end of 2021, and I think the consensus thinks that the Fed is going to be decreasing Fed purchases in the amount of 15 billion per. They will be deciding a decrease of the amount of 15 billion less purchases starting, let's say, in early 2021. Right now, they're buying 120 billion bonds. Now, I think the risk for an earlier tightening and more intense hawkish rhetoric is there, and the markets are still underpriced for that. Inflation has been, it is likely that inflation is temporary, but I think the main factor that's different from other events where we had too much QE and too much money supply was that this time money supply does not go to the bank vaults and to the markets. They go directly to people's pockets through the budget deficit, because right now the Fed is actually financing one-to-one almost the treasury.
Yeah. Okay. Yeah. I mean, the way that I kind of think about asset allocation, at the subsector level within metals and mining, but then also outside, just generally speaking, is where are growth and inflation going at any particular time, and more specifically, it's always about the rate of change, right? So if real yields are not really going to move, they're going to kind of just stay where they're at. Like there's no impulse to catalyze a move. So I'm kind of in the camp of precious metals equities in general, being driven by more idiosyncratic company-specific catalysts, such as new mines coming online or something like that, versus a broad-based move in gold prices specifically. I just think that given the fact that there is upward pressure on nominal rates and in effect real rates to a certain extent, you would need the other big variable in the picture, which is the dollar, to really, move lower in order to kind of create some more running room for equities in general, and in gold specifically. So if real rates aren't really going to go anywhere, they may just be in a big chop fest of range trade, then you really need the dollar to move, low, like remarkably lower, demonstrably lower. And I just, it's hard to see that right now with the growth cycle peaking to a certain extent on a rate of change basis. Like, COVID has really like messed up a lot of things as you look through that growth and inflation lens, even for cyclical or reflationary, industrial metals like base metals or steel or bulks. So we are in a really tough period, but I am more privy to saying that it's probably tougher sledding in general or from a broad-based perspective for precious metals equities, at least over the second half of the year. And then God forbid we actually get the government to put forth some sort of infrastructure package. I just, on a relative basis, gold equities do not set up positively versus steel stocks or base metals in that particular environment.
Well, today, if you look at the latest figures, the service of the debt expressed in a percentage of the US GDP is sitting around 2.5%. This is what we have today. I don't have a model to answer you directly and say above that specific level, the United States of America is going bankrupt. I don't. And frankly, I'm not a fan of those low probability, extreme scenarios. I see more of the same, which is more debt, more deficits, and hampering any potential growth in the economy. And suddenly we'll face more deadlines, and the deadlines are suddenly we'll have to pay more taxes because we realize that we have too much debt, and somebody has to pay for that generosity that we've had along those decades. So, and you have all those, pro new monetary policy, and they say, you know what, we can have 150% of debt to GDP. Who cares? After all, we have other countries. Japan would be the first example who demonstrated that it's not the end of the world. So we can have more debt, and yes, we will have to pay it down the road, but with inflation, we'll be able to amortize the service of the debt. All this leads to one thing, and again, we don't have a crystal ball, but the fundamentals are deteriorating. That's obvious. And because those fundamentals are deteriorating, because the valuations of the stock market are really, really stretched, because you're getting 1.5% on your 10-year, knowing that you have huge deadlines, one of them being renegotiating the ceiling of the debt coming really in the short term, again, like every year actually. So we have to think a little bit and say, where do we have potential investment, a decent investment return in this environment? And frankly, it's not because I'm running a precious metal fund that I'm saying it, but frankly, you need to have some gold in your portfolio.
It is very much, and I think the news we saw here just the other day, Yellen was out talking about wanting to raise the debt ceiling. At least in my lifetime, every time we've raised the debt ceiling, eventually gold falls along with it. We're sitting right now at 28.4 trillion in debt, and I pushed my numbers out a little bit farther, but I think if you get into the first quarter of next year, you could see our debt even as high as between 34 and 36 trillion. You got the infrastructure deal coming, some type of a new green deal coming. President Biden's promised some type of student loan forgiveness, and we're running a monthly deficit that's just huge. And I think as those things add up, you can only ask the Fed to print dollars for so long before you begin to dilute the currency. And as that loses value, the price of gold should do very well. So I think gold's actually going to surprise people, and it's going to be a debt, a currency crisis, a debt/currency crisis that's going to come and hit us. If not late this year, then early next year. I believe that's on the way. So